Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Welcome back, everyone. Episode 162 of Carson's Facts versus Feelings. Volatility, may I meet you? And if you know what we're making a joke about, then you know we're making a joke about Bill Ackman in all his boomerish ways gave a lot of advice to younger people, saying to men specifically, you should walk up to a woman and say, may I meet you? Now, all I'm going to say.
How did you meet your wife?
Well, we'll get there in a second. Well, I was going to bring that up. We'll get there in a second. I did not say that. But there are just disastrous videos of this. I mean, men are walking up to women all over the place, filming it, saying, may I meet you? Maybe they're, staged, but I don't think a lot of them are. It turns out, if you're tall, if you're good looking, if you're confident, come up to someone and ask them, may I meet you? They're okay with it. But if you're not, the results can be disastrous, probably like we expected. But anyway, we're having a play on Bill Ackman's. So I met my wife, I guess it would have been over 20 years ago, just at a bar, sat down and knew some people that I went to Xavier University with, nice. And they knew her. And my friend was dating, I guess, his future wife at the time, future wife coming. And they worked together and we sat there and started talking, and my joke has been talking ever since, I guess. So over 21 years, I guess, something like that. So nice. Long time.
16 years for me. And so funny anecdote here, but my wife and I met at a play. We were set up. So, now I knew that she didn't. And so we were at a bar after that. We were talking, and then turns out something wasn't working with her iPod. This was way back when.
Oh, yeah.
And she'd lost all her music. And here I was like, I was telling her, this is how you fix it and things like that. And we still joke that, later on we went for a date and things like that. But, we still joke that she was just treating me as standard, stereotypical Indian guy tech support, right?
Hey, yeah.
But it worked.
There you go.
I did not say, can I meet you, though?
Yeah, well, no, I don't think so. Did you play some Sting? I know both of you are big fans of Sting, right? Is that what you connected on, Sting?
Yes, that was that Sting and Peter Gabriel.
There you go. So, all right, so anyway, let's get into it. I mean, Sonu, there has been a lot of volatility. I just did some numbers playfully, of course. The government was shut down for 43 days, gained the S&P 500 annualized up over 20%. Now, that's annualized over those a month or so, month and a half or so. But since the government opened up the last 3 trading days, the S&P 500, are you ready for this, is down 220% annualized. So I don't know.
3 days.
Just shut it down. Shut it down. Shut it down.
Keep them shut.
There's a lot of ways we can go with this, but what sparked that? I don't believe it was open up the government. What do you think really sparked this recent weakness that we've seen? This volatility, if you will, that we've seen. And may I meet you, by the way, volatility.
I think it's since the 29th of October, the Fed.
Yeah.
We have a more hawkish than expected Fed.
Right.
And look, Powell said there were divisions in the FOMC after during his press conference after that October meeting. He said there are strongly differing views within the committee. I mean, we did get 2 dissents, right? Moran wanted 50 basis points of cuts, obviously. And then Jeff Schmidt, right, of Kansas City. He didn't want to cut at all. Fast forward 2 weeks from that meeting, and you had like a slew of Fed officials come out, and all of them are like, we want to be cautious. The government shutdown. We don't have data. And even dovish members like Chicago Fed President Austin Goolsbee is like, when it's foggy, let's just be a little careful and slow down. And then you had, so all the regional Fed presidents seem like, okay, we don't want to cut. We're scared. It feels like they've got some cold feet. And then you had amongst the governors, so this is where Powell, Phil Jefferson, Cook, Moran, and then you had Governor Barr as well. He's like, he thinks GDP growth is actually okay. We've got a little bit of strength. PCE inflation, which is the Fed's preferred metric of measuring inflation, that's moved up and it's well above 2%. We've talked about that. It's closer to 3%, right? And he said, common sense would indicate that when there is a lot of uncertainty, one should move cautiously. I think that just underlines where a good chunk of the committee. I don't know that it's a majority, though. Right? Which is why the odds of a December rate cut before the October meeting was like 90%. Maybe, David, we can put that chart up showing Fed rate cut odds. And right now it's less than 50%. It's about 40, 44%. So markets are pricing in no cut in December.
So, yeah, I mean, it's interesting because all that seemed like it came out Thursday. Like all of a sudden, I know it was scheduled, right? All these different speakers, Fed speakers. It's like, that's why I love the quiet period 2 weeks before the decision. You don't have to hear all this stuff. Just listen to Tim Moroso with the Wall Street Journal is all you have to do. But boy, they all just came out and said about the same thing. But when we did the live stream, Facts vs. Feelings live stream back on Halloween, we tried to get Austin Goolsbee. And the main reason I thought it'd been hilarious to have someone named Austin Goolsbee on our live stream for Halloween. And it didn't work out. But one of the, I mean, not why one of them, but I think he's funny. I think he's charismatic. I think you put a camera in front of him, he's good. But also some of his views kind of align with us. Like at the time in October, he was kind of talking about rate cuts. And now he's even in that camp that, like, I love how you said it. Well, he said it. If it's foggy, you should go a little slower. Neil Dutta, friend at RenMac, we have a rule to quote RenMac or quote
Neil's pretty upset.
Well, Neil said, hey, if they don't cut in December, it's not like they're going to cut in January. You're not just going to stop and not just going to start up again. Or if they do, we've got bigger problems because maybe things are slowing down and maybe all that economic data we didn't get for a while is coming out and say, oh boy, look at that. The labor market is slowing down. One more thing. Was it Waller yesterday who really kind of called out a lot of his peers? Yeah, I want to get him on our pod. He's got an opinion. Waller was fired up. What exactly?
He's
fired up now. Yeah.
Yeah, he's like, look, he was saying like, look, inflation's been above, just because it's been above target for 5%. For 5 years. 5 years doesn't mean we shouldn't cut.
Yep.
I mean, the irony is kind of saying, screw the inflation target here, right? We need to protect the labor market. That's literally what he's saying, which is fine as it is. I don't disagree that there should be cuts, but my view is, look, we'll see what happens when the government data comes out for payrolls. We won't get October data, so that's out, lost forever. We'll get September payrolls this Thursday.
Okay.
Right. So that's Thursday, the 21st, the day I'm going for vacation. That's all I know. Like I'm on vacation. I'll be on a plane, 14-hour plane ride. And that's when payrolls come out. Hopefully I'll be sane enough after 10 hours of sitting on a plane to look at that data.
But you're solo, right? No kids, at least. I mean, that's...
No, I have kids too. The whole gang's
Why
going.
did I think you were solo? Okay. My goodness. That's going to be miserable. I just thought you'd watch.
Solo's in December.
Here's what I thought. I thought Sonu was going to be watching some Fed stuff, some government data, watching a new Landman. I thought you were going to have like the greatest 14 hours of your life. Now it's just real. Well, I know you're going to try, but with eight, right? 8 or 9. How old are the kids now? What are
they? 9.
2 9-year-olds on a long plane. I don't care. That's good luck to you. And by the way, everyone, when the market goes nuts next week, blame Sonu, because every time he goes on vacation, this stuff happens.
I'm going to the Middle East. So but anyway, the data is, we don't have data. We'll see what happens. I don't think it's quite like, we are not going to get a cut.
Okay.
I think we could get, when we get November payrolls, which will be before the Fed's December meeting. The December meeting is on the 9th and 10th. Right. So we will have November payrolls. And so that will be, as recent data as we can get. Right. So I don't think they'll be completely flying blind. That's a good thing. And look, if the data comes in short, let's say we get 0 to 30,000 jobs or negative jobs created in November. Yeah. We'll forget September. Right. I think we get a cut, period. Now, if it's above 50 or 60,000, I think it's clear we don't get a cut, period. Now, if it's between 30 and 60, that's the thing, right? And I think Powell is key here, right? I forget who we talked to. Somebody told us.
I don't remember.
We were asking him about how Powell operates, right? Before the Fed meeting, he literally talks to everyone on the committee and tries to figure out, okay, where are you with respect to, do you want to cut or do you not want to cut? What's the deal, right? What are you thinking about? And he, I think, tries to push the committee towards a unanimous vote more often than not. This time, obviously, it seems like it could be a 6-6 vote, right? The chair, by the way, doesn't get a tiebreak, right? The chair, but then usually the chair votes last. Greenspan always used to do this. He used to vote last just so that he's on the side of the majority and there's never a 6-6 tie, right? If there is a 6-6 tie, well, nothing changes. Policy stays as is. That means no cut. But I think there's too much noise around whether or not we get a December cut. the market, if you just look a little ahead, Powell's going to be out as chair in May. I think Trump's going to get his person in. There's another Fed governor who resigned. I forget who that was. The Atlanta Fed. Maybe the Atlanta Fed. Bostic. Yeah, Bostic's going to go. That means he's going to be replaced. Now, I don't think that person coming in will be a voting member of the FOMC next year, but still, there'll be one more voice, presumably, in favor of rate cuts, right? And so the market's still pricing in, Ryan, about 3 cuts in 2026. And I think that's a big picture. Irrespective of what happens in December, we're going to get rate cuts in 2026. Unless we suddenly see, oh, you know what? The labor market is really strong. The economy is really strong. Or we have an inflation problem. If you have an inflation problem, all bets are off. But if the labor market is strong, if GDP growth is strong, that's not bad news. That's good news. Right.
Well, that's kind of.
I still think we get cuts.
Yeah, we're not cutting because the economy is strong. Like, oh, it doesn't sound on the surface like it's bad news.
Doesn't sound bad.
The Manheim Used Car Index, which I learned this. I might have been talking about the Manheim Used Car Index probably for 10, 15, 20 years. And like 6 months ago, I learned it's actually in Manheim, Pennsylvania. I never knew that. I thought some guy's last name or something. Anyway, so the Manheim Used Car Index is down 8.4% the last 3 months, annualized. Also, Zillow, the rent index year over year is down 2.4% in October, one of the lowest we've seen in a while. So there are some parts of the private data that are saying inflation could have a little bit of a lid on it. We talked about shelter a lot the last time we got employment data. I'm sorry, wrong word. Inflation data and shelter finally, after like 3 years of us talking about it, looked like it might be cracking, putting a lid on it. We know goods prices are higher. You got that chart, right? You want to go to that goods prices chart? Didn't you share that? Actually, or did I steal your thunder?
No, it's good. Actually, do you want to talk about the chart that was going around the San Francisco Fed study? And
let's go there. So, David, what do we call this? The scatter plot? And David's like, there's a lot of dots on there. The one with a lot of dots on there. This came out, I guess, maybe on Friday or Saturday. Well, who knows when it came out, but the reality is it went wild, along with May I Meet You. That was the number one thing everyone's talking about. But secondary is the San Francisco Fed looked at 150 years of tariffs, and they concluded in bright lights, tariffs don't cause inflation. Sonu, tell us what it really said.
Congratulations, first of all, to the San Francisco Federal Reserve researchers for releasing a viral paper. We all want something that goes viral. And
outside of Cliff Astis's paper, and he joked again on Odd Lots, the most read paper he ever had was when he talked about pulling the goalie in hockey. It's like he's done all this amazing work in his career, and that's the article everybody wants to read. Now, this is what actually people want to read from our friends at the San Francisco Fed. Go ahead, Sonu.
So anyway, by the way, the researchers, every Fed, regional Fed has researchers, even, Powell is researchers up in DC. It's not official Federal Reserve policy anytime they release a paper. So when they say, oh, the San Francisco Fed released a paper, it's actually the researchers, the economists there. It's not official, like, oh, yeah, we are buying into this, anything like that, right? They may have different opinions. But anyway, they released a new paper studying 150 years of tariff policy. And the big takeaway, as you said, tariffs lead to lower inflation. But be careful what you wish for. In fact, forget reading the rest of the paper. Even if you didn't, just read the abstract. Literally take you like 15 seconds. This is what was written in the abstract. We find that a tariff hike raises unemployment, lowers economic activity, and lowers inflation, right? In fact, even in that regression plot that everybody and their mother is sharing, you can see on the left side, okay, inflation goes down with higher tariff, but the unemployment rate also goes up, right? The mechanism by which higher tariffs lead to lower inflation is because aggregate demand, everyone consuming and spending, things like that drops for two reasons. Higher unemployment, leading to a weaker economy, and lower asset prices. Stock prices go down, and because of that, you get a lower wealth effect, lower spending, right? Both are bearish narratives here.
Right.
I would argue, and we have argued, that neither are true right now. Yes, the labor market is weak, but the unemployment rate, look, in March, it was 4.2%. Okay. As of August, it was 4.3%. Not a big increase. Yes, hiring is low, but firings are also low, right? We've seen that from, a state unemployment benefit claims data. And then the stock market. It's risen 6 straight months. Yes, we have some volatility now. Maybe you should blame Bill Ackman for that. But maybe you blame the Fed. But look, stock prices have risen for 6 straight months. The S&P 500 is close to a 16% positive, 16% year to date. Less than maybe or 3.5% off a record high.
Mm-hmm.
I think, like, do you want to believe what you have seen and what we've experienced for 6 months? Or do you want to look at the paper and say, oh, no, inflation, tariffs lead to lower inflation?
Right.
I don't know.
Well, no, lot there. It kind of gave something for everybody, that report. Oh, see, I told you tariffs don't cause inflation. And then if you dig into it, well, it's because there's other parts of the economy that slow down. So did you have the chart on?
Oh yeah,
goods?
let's put the core goods. Yeah. That's the thing. Like in our lived experience over the last 6 months is that we have gotten core goods inflation. So David, if you put that chart up for core goods prices, CPI for commodities outside of food and energy, that's up close to 4% annualized over the last 6 months. This is May through September, right? Inflation for core goods was negative 0.7 in 2024. And historically, from the mid 90s all the way through 2020, goods prices are falling. You had a negative inflation rate. It's higher now. And even if you look at individual categories, right, over the last 6 months, furniture and bedding, inflation rate is about 7%. Vehicle parts and equipment, inflation rate is 6.9%. Toys, 5.5%. Recreational commodities, video, audio products, sporting goods, things like that, close to 5% inflation. Apparel, 2.2%, right? In fact, the Fed is arguing that the pickup in inflation is due to tariffs, and that impact is one-off. It's transitory, and I believe that. I would argue that too. And look, if tariffs didn't lead to inflation, the Fed wouldn't be saying that, and they would have probably been cutting rates way back in June and July.
Right.
Same thing with the administration, by the way. The White House, what was it, Friday, Ryan? They dropped
Friday
tariffs.
after the close, after a nasty Friday, they dropped some tariffs on Friday afternoon.
Tariffs on coffee, meat, tropical fruits, bananas, things like
juice.
that.
Yeah, stuff we all use.
Yeah.
Mm-hmm.
I thought that stuff comes from Florida, by the way. I don't know. I don't know how the global orange juice markets work. But anyway, they dropped tariffs on all this stuff to ease affordability, right? That comes in the wake of like election results where voters were really upset about affordability. But hey, that's an implicit acknowledgement that tariffs have led to higher prices, right? If tariffs did not lead to higher prices, they wouldn't be dropping the tariffs. So anyway,
well,
beaten that.
Yeah, not there. Reminds me of the old Groucho Marx quote: "Who are you going to believe, me or your own eyes?" You know, our own eyes do show a little bit of a different thing out there, like they historically do. Well, you want to talk markets a little bit? Do we beat a dead horse on the Fed and inflation enough?
Actually, let's go back to that question. Like, we started with the question, like, when did, what started this volatility? And that's how I got to the Fed. I was going to ask you, and you take it any direction, but Bitcoin, crypto, right? Crypto's down, Bitcoin's down like close to 20% since that.
More than that, yeah.
Since October, since the 28th.
Oh, gotcha.
Since the Fed meeting.
Right.
It's been down even more. Now it's down close to 25-30% or something.
Gotcha.
I'm curious how you think about that as like a risk-off signal, or is it like a leading indicator for say, you know what, people are getting scared of the market?
Yeah, no, great question there. I will say, so on October 10th, I believe it was, when we had one of the what Tom Lee over Fundstrat calls it one of the largest liquidity events ever in the history of crypto. That was when the talk that President Trump wasn't going to meet President Xi, stock market sold off. And for some reason, I don't quite get it, but for some reason, crypto just was annihilated on that day. And we're still kind of feeling the waves, the ripples, I guess, of that initial big selling on October 10th. I think you do have to look at it like a little bit of a liquidity risk on, right? I mean, to see crypto falling like it is.
Oh, risk off.
Risk off. Apologies. Yes, risk off. And again, it's more for tech, I guess, and tech adjacent. I don't think it's anything that's not too obvious with AI. And we've seen some people lay the chart of the NASDAQ 100 with crypto or Bitcoin, and NASDAQ 100's, I'm showing on the YouTube channel, look kind of up here, whereas Bitcoin's down there. It's like, who's going to play catch up, right? Will Bitcoin go up, or some of the large cap tech go down? And honestly, the last 4 days, I think we have our answer as to what's happening. Now, I did see some charts and things. We look at flows. I mean, Ethereum is kind of like the number 2 crypto.
Okay.
Jeff DeGraff just sent this in his morning note of Renmac and showed historic outflows on Ethereum. Now, that means you're probably in the ballpark of a potential low. There's a lot of negativity, obviously, with what we've seen. You know, I saw, I forget who exactly said it, but it was along the phrase of this year, Bitcoin's having like its IPO. Right now, it's not having an IPO,
Sure.
but a lot of people who've made a lot of money are
like
getting
it's coming out party.
Yeah, it's like they're starting to sell here. Now they're going to sell to new hands, to new people, to institutions and things. But that's kind of like some volatility and adding to some of the weakness. And again, look at great companies. Well, they have an IPO, and that's when some of the founders and different people, investors get out, or not get out, but cash out to a degree. You know what I mean here. And then the company continues to grow and go from there. So this maybe is the more optimistic view. As someone who's in that world, I kind of thought that made some sense. I mean, yeah, I believe it's 6 times in the history of Bitcoin. It's dropped 75% and way more 50%ers and 40%ers. Now we're ballpark down 30 the time we're doing this. So these things happen. But I do think if you just simply look at periods when it's happened, it's normally been during weak periods of the market. Now, again, it's all relative because, David, we can put up the chart about how the S&P 500 hung out near the all-time highs for a long time, right? So, for over 5 months, the S&P 500 was above its or within 3% of all-time high. I mean, think about that. For 5 months, the S&P 500 hung out right within 3% of all-time high. Obviously, that ended earlier this week on Monday. So we had an incredible 14 months in a row right after the election in November of 2016, where for 14 months in a row, the S&P hung out within 3% of all-time high, by far the longest ever. And I make the joke that night when the election happened and the market crashed and all that crazy stuff was going on, if you made the bet to yourself for 14 months, the S&P be near highs after this election, I don't think anybody would have believed you because that just wouldn't have made sense. But markets sometimes can do this. Now, we also had some records. Monday was finally down, right? 10 Mondays in a row, the S&P 500 was higher. Well, it had to end eventually. The other ones, the S&P 500 broke its 50-day moving average for the first time in more than 6 months. I mean, that's a very, very long time. I looked at previous or other times, like 21, 22 examples of when the S&P 500 goes at least 4 months. Oh, what was that? Somebody break something behind you there, Sony? What was that?
No, I'm worried now.
Are the kids home? Are the kids home?
No, the kids aren't home.
Is there a ghost?
No,
we did it.
Home.
We did it. We caught a ghost on our podcast. We've never officially had a ghost.
I have no
I love
idea
it.
what that is.
I don't know. God. Somebody broke something. I don't. You don't have a cat. You don't have a dog.
I don't have a cat. I don't have a dog. But I wonder if it's outside or something. I'm right next to the windows.
The only logical explanation is you have a ghost. I mean, that is the only thing that makes sense. We have we always have guests.
And I am terrified of this stuff.
I am terrified of that's why we keep talking about ghosts. I mean, it's oh my goodness, look behind you, Son. I see the girl from The Ring. I'm teasing. That's that movie. I know that. He's not going to talk to us this podcast. What were we even talking about? I was going on a rant. I really got sidetracked by the ghost.
Markets, yeah.
I don't know what I'm talking about. 50-day, break the 50-day, then the ghost came in. So the ghost did not like that 50-day being broken. Anyway, so like 21 or 22 times we broke the 50-day after 4 months above it. And sure enough, 1, 3, 6 months later, returns are actually significantly above average. And I think the real simple thing I like to look at is the S&P 500's 200-day moving average, a long-term trend line, still firmly pointing higher. We're still well above that. We get the volatility. We get the weakness that we've had. But so do you and I, along with various members on our team, managed nearly $7 billion. Might not quite be $7 billion anymore because market has sold off. We actually, and I have to admit, I was pleasantly surprised by this. We had a pretty good day yesterday. Now, if all you heard was, those Carson guys are always bullish, they're always all this, all that. Yeah. I mean, we had a pretty good day. Now, again, this is relative to benchmarks. We live in a world relative to benchmarks. Yes. I mean, stocks were down, so sure, we were down. But relative to our benchmarks, we had a pretty darn good day. And you and I both were pleasantly surprised.
Being overweight equities.
That's what I'm getting at, being overweight equities. How are we constructing, without giving too much away, but let's tease a little bit. How are we thinking about constructing portfolios? Because someone might think, those guys are 71% equities. They're all in AI. They're all in the hottest stuff. Yeah. They must have been destroyed the last several days. Not really. Yeah, how are we looking at it? Yeah.
Look, when I think about, I asked the question of crypto. When I think about crypto, my immediate thought is, more about that stuff than I do. I honestly don't follow crypto much, and Ethereum. And you start talking Ethereum, I'm like, I have no
your
idea.
eyes. It's like when I hear jolts. I hear jolts out of the back of my head. Yeah, same thing.
So, but translating that to the equity market, I think of it as sort of junk tech, or and a good proxy for that tends to be, your small growth stocks, right? Okay. Since the Fed meeting, they're down about 8%. The S&P 500 is down about 4%.
Okay.
Growth stocks, large growth stocks, you have Microsoft, Apples of the world, all of that's in that category. That's down about 6%. Value, large cap value stocks have been doing better.
Yeah.
Right? They're down only 2%. And foreign developed stocks are down about 3% right now. Emerging markets have gotten hit a little harder. But you look at the sectors, Ryan. I mean, healthcare is positive during this period. It's up 4.5%. I want you to touch on that because I think you mentioned something interesting the other day about what's driving healthcare. Is it the defensive part or the more, biotech growthy parts of it? Energy's up. Materials that, was sort of hanging on there up until today. But by the way, and bonds are down, right? It's almost like no diversifiers have worked unless you were sort of like an international, little bit of value, a little bit of low vol. And that's a lot of what we have too. I mean, we have the other stuff. We are not underweight technology. We're not overweight technology.
Right.
We probably don't have a lot of junk tech in there, but we are neutral technology. We want to ride that AI wave because that could go on for 6 months. It could go on for 3 years. Nobody has any idea. I think anyone would be lying if they tell you we know exactly when this is going to crash and burn and things like that. You have no clue. So you have to sort of barbell your portfolio, in a sense. By the way, what's done well over the last 2 weeks? And this is like people have been mocking gold. Since the Fed meeting on the 28th, gold is up about 2.5%.
Hey.
Right. And now, excluding whatever is happening today, we're recording on the 18th up until yesterday. Gold is up to 2.5%. And this is with all the mockery about, look, gold is going down. And hey, that's why you have a diversified portfolio. Commodities are up too.
Oh, yeah.
I think you shared a chart on copper. Actually, I wish we had that chart. Anyway, forget that. Copper has been going up. I think there's a global growth story here, which came out in earnings too. Activity in China is picking up. Activity in Europe is picking up. A lot of these places. And that's good for a lot of commodities. Yes, I know oil is down, but look at natural gas prices. Natural gas prices are up. Exactly. Copper prices are up, right? All commodities are not getting destroyed here, right? So just some perspective.
Yeah, and if they were, that's probably a bigger sign of something bigger, more like a ghost. Like a ghost is out there, kind of causing trouble. So yes, we're still constructive. Yes, we're still overweight equities. But when we say that, we construct a portfolio. We use barbells. We've got some utilities in there. We've got some industrials in there. We do have some technology in there. But they all can't go up at the same time. And we still like gold. I mean, every time I look at gold, it's still above 4,000. And I know it was well above 4,000, but it's pulled back some because it can't go up all the time. But gold's just kind of consolidated up above 4,000. I think it's catching its breath. I still think gold's in a major structural bull market as well. And after the run gold had, I mean, specifically after the Fed meeting back in October, or was it September? It was Jackson Hole. It was Jackson Hole. Jackson Hole is when gold just went bonkers. Well, it's been going bonkers for years, but that really put it in the hyperdrive. So gold makes sense. So again, keep a diversified portfolio. We have a little bit more international, probably just by any other RIA our size out there. And we did that earlier this year. We don't like emerging markets as much, but we still do own some. I think those are some key reasons why our portfolios have done pretty well, weathered this storm. You always can look back. I wish we did something different. Believe me, we manage money. You stay up at night thinking about what I could have done differently quite often. But we're pretty proud of how we've done things on the Carson Investment Research team to help our amazing Carson partners and their clients. All right.
Actually, so I'll put some numbers here just to give you some perspective on,
let's do it.
Commodities. We were talking about commodities, right? And you shared that chart on copper. So I don't have a chart. This is why our friends at Employ America, Skanda Amarnath and his team, they sent us a nice email showing like a commodities monitor. And year to date, this is through last Friday, copper, Ryan, is up 27%.
Wow.
Natural gas is up 26%. Jet fuel is up 9%. That doesn't tell me that world economy is on the verge of collapse. Diesel is up 9%. Aluminum, now that's maybe due to tariffs and things like that. That's up 12%. Steel is up 27%. Yeah. So oil is down. Oil's down 14%.
I'm going by memory, but I believe silver is up 70% for the year as of Friday.
Right.
Also.
Yeah.
So that's a little different. But the silver, to a degree, isn't it? Silver kind of has metal. It's got some industrial metal and some other components. Which, by the way, I do want to jump in. You mentioned healthcare. Healthcare has been amazing. Another thing that I've talked about other people. I saw Jeff DeGraff mention this too. But we're all watching the same stuff. Why is healthcare doing so well? Because biotech is breaking out. I mean, biotech, if you look at a bunch of different subsectors, biotech might be the darn near strongest one in the past month. I don't know, maybe something better, but biotech's about as strong a group as there is out there. It's hard to get super bearish when I see biotech is leading. It's like that'd be a group you think would be weak. We talked a week ago at how well European financial banks have done. Now, they've come back a little bit with this weakness, but literally a week ago right now, European financial banks hitting all-time highs. Those aren't necessarily risk-off scenarios, at least the way we see the world. What else want to add there, Sonu?
No, I think that's it. We were probably due for volatility. I mean, it's always a cliche. I know it's a cliche to say that. Yeah, we didn't get volatility. We were due for volatility. What does that even mean? Did we predict the volatility? Not quite. But is this surprising? No. It shouldn't even be surprising that, look, we haven't had a 3% pullback for ages, right? I mean, for a long time. Yeah. And from one of your charts, I wish we could share it, but I don't have it with me right now. You said, every year on average sees at least 7 3% pullbacks.
Yeah.
We barely had any.
Well, we finally had one, but the first one over 5 months, like we talked about. So, yes, you're exactly right. Volatility is the toll we pay to invest. We say that a lot around here. We also say earnings drive long-term stock gains. Those are two things we say a lot. Earnings have been solid. We don't need to say too much more about earnings season. We've hammered it home. I will say Warren Buffett dipped in his, is it Cofers?
Yeah.
Dipped out his Cofer. What's a Cofer? I don't know what a Cofer is. What's that phrase?
I don't know.
Whatever. Dipped in his Cofers and spent $4.3 billion on Alphabet stock. Now, he did sell, with my math, if I can read my own writing. Did he
sell Apple? Or
sold over $10 billion of Apple and $1.9 billion of Bank of America. But he had some pretty darn good gains in those. So there are some things. And also,
maybe he's diversifying too.
Very well could be. We've heard for a while, Buffett has record cash. Buffett has record cash. That's bearish. But the stock market has done pretty well in amidst all of that. Michael Burry, we talked about him last week. He shut down his hedge fund, which I thought was odd because he made all these shorts on all these things. He's saying how all these companies are scams, and I'm not going to get into the weeds of it because some of it is company specific. Talk about their earnings in 2028, 2027 are going to be lower because of the way they amortize things. And again, this is way above my pay grade. But he shut down his hedge fund. I thought that was odd because he made these bets. If he's truly bearish, why he'd do that, I don't know. I'm not sure. The contrarian in me wonders when a bear shuts down his hedge fund. Is that a worrisome sign? That got me. That's what I was talking about. Insiders. Barron's has a really nice chart that comes out every week and looks at insiders. Insiders are buying right now, right? So that's a potential positive, if you ask me. Insiders are still finding deals and buying more equities than they are selling. And again, you tend to see major selling. If you think the smartest person in the room is someone who works at a company, and if they're selling, listen, someone like Jeff Bezos, well, listen, he could sell some Amazon. He's been in it forever. That's fine. But
probably has to buy a new yacht.
Exactly. But usually if insiders are buying, I mean, that's even a better signal. Because insiders sell for all different, hey, you want to buy a house, want to buy a yacht, go do it. I'm all for it. You've earned it. But if they're buying, that's some I think some positive developments, and we are seeing some of that along with strong earnings. Those are just some big picture macro things we think about a lot when we see this well-deserved volatility. One more thing, Sony, then I'll go to you. We were probably due. I mean, we've been saying for a while, listen, S&P's up 6 months in a row, NASDAQ's up 7 months in a row. I said the first half of November could be choppy. Well, I think it's more than choppy. This is a little more than I expected, but nonetheless, it's happening. I'm still optimistic that we can get a good flush out of fear here. Actually, put that one up, David. Let's put that up. The latest Economist magazine, speaking about fear, shows, I'm going to say it's Santa. I don't know if it's Santa officially or not, but Santa was skiing, had a little bit of a mishap, and you see kind of like these arrows that are pointing lower. There is skis. The way I grew up listening and reading Paul Maker Montgomery almost 20, 25 years ago is when you see things like this, that's telling you a lot of this stuff's priced in. Doesn't mean the market can't go lower. Doesn't mean the market can't be volatile, but a lot of this is priced in. We shared a ton of these charts back in April and May that were way over the top negativity, and the market went up. No, we don't blindly invest just on magazine covers, but I do like to pay attention to them. The AAII sentiment poll, Sonu, and I'm getting pretty good at getting it right. Let's see here. American Association Individual Investors. See, it took me about 10 years to get that right.
By now, I think our audience hopefully knows that.
We talk about it a lot. I get it. There's some flaws with this one, but we just saw 49% bears last week. Sonu, before this year, the only time in history that we saw that many bears with the S&P 500 at the time of the survey within 1% of an all-time high was April of 2023. Now I'm going to show my age for a minute here because I'm an old guy at this point. I remember April of 2023. You know what happened? The S&P 500 broke out of a 13-year secular bear market. Major peak in 2000, cut in half all the way back up to 2007, made new highs, like 4 or 5 new highs, something like that, and then cut in half again. And then April of 2013, we broke out the new highs. And that was starting the new secular bull market. It's a theme I've talked a lot
Did it
about.
take 6 years to get back to the highs? I didn't realize that. Well, 2007 to 2013.
Sure did.
Wow.
Sure did. Yeah, like, I mean, a ballpark 1,575. And this is approximates, but that's about the peak. That literally the peak of 2000, peak of 2007. And we got back there in 2013. You and I were talking, I think it was you and I don't know. I'll act like it was. You and I, well, go ahead. Yeah.
No, I was going to say, yes. I think yesterday you and I were talking about, both of us obviously graduated from
That's what I was going with. That's what I was going with.
Right?
Yes.
And you know, everyone talks about, like the kids today.
We talked K-shaped. We talked K-shaped last week, the K-shaped economy. Yeah.
Right. And you know, wait, like if you graduated around the .com bubble and crash, subsequent crash, you had the stock market in a big bear market for 2 years or so. And then in 2008 hits, you had pretty much a lost decade, as we just talked about. 6 years it took to get back to previous record highs. I was like, that was tough.
Yeah. Or people that were born like right before the Great Depression, and you had World War I, a Great Depression, and World War II. So the way I took it was I graduated in 2001 from Xavier University. I started the job around November of 2001, right after 9/11, right after the bear market. Things got going again in 3, 4, 5, 6, 7, and then boom. Literally, everyone I worked with was losing their jobs. Companies are going under. If you were in the financial industry, I had so many friends that became advisors or brokers, whatever you called them back then. They all were quitting. It was just, it was horrible. People losing their houses, losing their jobs. That was a terrible time to start in the workforce in 2000, 2001. All right. People are, older people in the early 80s was starting off, with interest rates super high and massive inflation, massive unemployment. We're not minimizing what, Gen Y and younger kids are going through right now, but a lot of us had it really rough. A lot of us walked to school uphill both ways without a coat on. Okay. I think is what I want to say.
I think you quoted Ben Carlson. Shout out to Ben.
Yeah.
I thought he had a great piece. He got, there's quite a few people on X, obviously, knocking him for, hey, because he was like, things are better than we actually think it is with the K-shaped economy and things like that. I'm in that same camp too, which is not to say there is no K. I think the K has existed. There's been inequality for a long time, for about 30, 40 years. But has it increased significantly over the last 6 months? Has it increased significantly over the last 2-3 years? I don't think so.
Yeah.
Right? I mean, I don't mean to deny that, we've had inflation and affordability issues and things like that. But as you just said, our parents were buying mortgages at 15% mortgage rates.
And our grandparents living through multiple world wars, and great-grandparents had Great Depressions. So,
and mortgage rates are what, 6.5%? Yes, I'm not denying that it's tough out there and things like that. But here's the other thing, and then connecting this back to the macro cycle and where we are today. Look, irrespective of whether I think it's good or bad or whether I think things are better, I think the Trump administration probably is a little worried about that bottom half of the K pulling down the top half.
Yep.
And I think they're likely to stimulate or provide some demand side help for the bottom K. And maybe it's some supply side help, and that's why tariff reductions on bananas and coffee and meat and things like that. But, there's a reason Trump is talking about tariff dividends. Originally, I didn't think he was serious. I thought, tariff dividends. But I feel like you have to take him seriously. I think going into next year, if the labor market looks weak and if the Fed is sort of dithering, if the Fed is like, we don't know, we may not cut, come January or February, I think they will try to figure out, how do we send checks out? How do we send stimulus checks out? Now, everyone may not get it, but people could see, let's say, $1,000 check coming in the mail just to help them with affordability. It's that whole, and this gets back to people compare the current cycle to 1999. Oh, it's a bubble and maybe it's a crash, or the housing bubble, things like that. I would say we had even an energy boom, right, in the mid 2010s, early 2012 to 2015. Energy companies, the shale revolution, all of that. Then energy went bust. That hit high yield and energy sector earnings, things like that. I've been thinking about, what if this is more like 1967, right? And neither of us were alive then, so you just go look at the data. Instead of the 1990s or even the 1970s, like I think inflation will be volatile. Our portfolios are positioned for that, but we're not expecting 1970s style inflation. No, right? Just think inflation will be volatile. But 67 is interesting because you had massive fiscal deficits, right? This is a time in the mid 60s, you had Medicare and Medicaid programs, the Great Society programs, Those were launched in 1965. It really ramped up by 1967. You had a ramp up in education, poverty, and housing programs as well. And then you had the Vietnam War too, right? So that's that whole guns and butter thing. And taxes weren't going up, right? The government's budget deficit was the highest. At that time, it was the highest we'd seen in several decades. It was about 2.5% of GDP. Right now, it's about 6 and 6.5% of GDP. But at that time, 2.5% of GDP deficit was massive, right? It was the largest peacetime mid-cycle deficit ever run by the U.S. government until then. Eventually, President Johnson put in place I think it was temporary, a 10% income tax surcharge in mid-1968. But 67, the Fed was also cutting. The Fed cut by about 200 basis points, Ryan, in 8 months. Because they thought, inflation's done. 66, they hiked rates because they were worried about inflation. That was actually the only false signal before this cycle when the yield curve inverted and we didn't get a recession.
Interesting.
Right? They were raising rates in 66. The markets fell quite a lot. And then they thought, okay, we solved the inflation problem. Inflation fell back to 2% or something.
Whoops.
And they dropped rates. 8 months, they dropped rates by 180, 200 basis points. Think of that. What a tailwind it is for markets.
Right.
Markets actually gained 50% over 2 years.
Right.
Into 67, 68 by November of 68. And I feel so you had a dovish Fed, you had massive fiscal deficits, kind of like what we have now. Yes, I know the Fed's, playing footsie with a December rate cut, but I think we'll see rate cuts next year. But that's kind of what we have. And that's an incredible period for markets. Now, the other side is after 68, what happened is inflation just spiked and the Fed had to come in and, crash the party, right? Well, which is what they did. They raised rates all the way to, I think they raised rates to 7-8% or something. They killed the economy. Economy went into a recession by 1969, 1970. That was the end of the cycle. And I think that is sort of the risk here. I know everyone talks about when is AI going to crash and things like that, but you need a catalyst for that. If the stock market continues to go up, I think this AI run can go, keep going up, right? Yes, ROIs, things like that, but set that aside, right? I think let's say we get to 2027, right? 2028.
Okay.
And I know this is a big pie in the sky sort of stretch here, but let's just play with me for a moment. You get there and suddenly inflation's not coming back down. Inflation's still 3%, 3.5%, something like that. And the Fed's you know what? We really need to push the brakes hard on the economy. That could end the cycle. Anyway, that's just something I'm thinking about. I haven't quite formulated everything else, but hopefully, that makes sense.
No, it does. That was a neat little history lesson there. I mean, I hear 1968, and there was a fairly major peak in the S&P 500, right? From 1950 to 1968, 18-year bull market. From 1980 to 2000, a 20-year bull market. This one started in 2013. Yeah. If my math is right, we're 12 years in. I do think it's not about the end. I think if you look at history, these cycles last longer than you expect. So some really interesting concepts there. I think it was 1971, right? The U.S. dollar used to be backed by gold, and then we said, no more. And a lot of people say back then that was one of the bigger policy mistakes potentially that led to a lot of inflation. I don't know if that's right or wrong. I do know the 70s had massive inflation with a lot of the things you just talked about. John Connally, Treasury Secretary for Nixon, in a room full of bankers, when they did it, they were furious. He said, yeah, but you know what? It's our currency, but it's your problem. Yeah, that's been our attitude toward debt. That's been our attitude toward the currency. We still have the world's reserve currency. We can kind of push people around when you have the world's reserve currency, and that's where we are. Well, it's funny because before Sonu and I do these, we prepare all night. I mean, we work. No, we don't. We just wing it. We're I don't know. Do we have enough stuff to go 40, 45 minutes? Sonu, we've gone 45 minutes. I guess we hit our mark. Anything else you want to touch on for a couple minutes before we wrap up episode? What is it? Episode 162. Volatility. May I meet you?
Yeah, we have met. Volatility,
yes.
it seems like
it's still today. It's a Tuesday morning.
Volatility is not as pretty as anyone expects ever. I won't take that.
Oh, I'll jump in just to make sure. Shout out again to Ben over at Ritholtz, Ben Carlson over at Ritholtz. He did a really good blog talking about maybe things aren't as bad as they're telling us. And look up Ben, and you can find him out there. But he wrote a really good blog over the week. It was I thought some really cool charts.
So I was looking at 1967 because that gets to our guest for next week.
Exactly.
This guest mentioned two two big secular bull markets. You mentioned that, the 50s, 60s, and then 80s and 90s, and how we were talking about how they come to an end. And that's what led me into, let me go see what happened in 1967, 68, 69 with, fiscal deficits and monetary policy. Do you want to give people a little preview of who we have?
Yeah, so I'm making sure I get the title right. Urian Timmer of Fidelity, the Director of Global Macro at Fidelity. We have Urian Timmer joining us. We've already recorded it. Had to, just holidays and Sonu's out of the country, but it was awesome. I mean, Urian's amazing. I'm a big fan of him. He uses technicals, he uses history, he uses fundamentals, a lot of stuff. I mean, he was talking kind of the way we talk, right, on our podcast. Mm-hmm. I've heard Urian on a lot of podcasts over the years, so we were just excited to get him. So definitely stay tuned for next week's podcast with Urian Timmer.
So I am scared to go upstairs now. But I do have to go out to get some milk. So the final anecdote. So I make chai for myself every morning. It's just my ritual. I boil water, steep the tea, put some milk. It's just like Indian version of chai. I put some cardamom in it and things like that, right? If ever anyone, anyone wants, Sonu's homemade chai, happy to anytime, or I'm happy to share the recipe too.
Oh, there you go.
But anyway, so I ran out of milk yesterday. So before our morning call, I went out the 7-Eleven right nearby. I ran out there, got some milk, and I was drinking it yesterday. I was like, this tastes funny. I usually put a little bit of sugar because I don't want to completely sugarless. And, I was like, this tastes funny. I don't know if you saw you probably didn't see my face wince during the morning call.
No,
and this morning, I made it again, and I was drinking. I was like, what is going on? Today I didn't put any sugar and it still tastes sweet. So I look at the milk bottle that I bought and it's strawberry milk. Strawberry milk. And then I'm like, oh my God.
Wasn't it like pink or purple? Wasn't it like pink? Don't they usually make the strawberry stuff real obvious?
I was probably looking at my phone and checking your Twitter feed or something when I was pouring milk in.
Yeah, that's true. That's true.
But anyway, I don't recommend strawberry milk for your coffee or tea. So
okay. Well, go.
I need to go get a proper bottle of milk.
Go get out and get some, I don't know, some crucifixes or some garlic or something to keep away the evil spirits. I don't know.
I'm scared to go upstairs.
Yeah. Well, Sonu, have a safe. Again, Sonu's traveling out of the country, so safe travels. I guess you and I will be back. In 2 weeks? I guess in 2 weeks with a regular one. That's
yeah.
What is it? Look at my calendar.
Yeah, maybe I'll try calling you when I'm there. I'm hoping to go. I'll be a couple of days in Dubai, so I'm hoping to see.
Okay.
My son's really excited about seeing the tallest building, the Burj Khalifa.
Oh yeah, dude.
You remember that Mission Impossible?
Tom Cruise. There you go. Yeah. Okay.
I'm not gonna. I should do a video running or something.
Oh, man.
No, that's not happening. But maybe you'll do a video or something if you're around.
No, that's if you can get on that thing and do a video, I'll wake up any time of day. I don't care what time it is over there. I don't sleep a lot anyway. I'm whatever. I'm always going. So, all right. Well, safe travels to you, Sonu. Thank you to all listeners out there. Give us a follow. Give us a review. Not positive, not negative. I'm not leading the witness. Just give us a review. I got in trouble for that before. That's my joke now. It does help. On the YouTube channel, we have the comments are open, so feel free to just leave any comment at all. It does go a long way with those algorithms. We appreciate it. So everyone, thank you again for being here with episode 162. And if you're a young gentleman and you see a nice young lady and you walk up to her and you say, "May I meet you?" let us know how it goes, because there's just been disastrous results all over the country with Bill Ackman trying to help people. They're funny. Go watch some of those. Just trust me, they are funny. All right, everybody. Urian Timmer's next week. You're going to love it. We'll see you then. Take care. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.